Another strategy I've been implementing lately is writing LEAPS covered calls, where you purchase a stock and sell a LEAPS call option. I will write these LEAPS covered calls even if the stock is not in a major trend up signal or bull signal, because you get so much downside protection from the LEAPS call option that you don't have to be, it's not that critical that you're right about the timing of when you enter these. In other words, this is a long-term trend. The LEAPS covered call can provide substantial downside, also substantial upside. So I've been writing a lot of these lately, and here's an example one I just did last week actually. And I bought 100 shares of the Brazil index at 33.69, and then I sold the January 10 40 strike LEAPS option at 7 points. So that's about a 15-month trade. And the options right now are providing a very rich premium. You can get a pretty good return and pretty good downside protection. This is the Brazil index. I bought the stock, the ETF stock, at 33.69 and sold the January 10 40 strike call at 7.10. So the break even on this is 26.59. So the ETF would have to drop to 26 before a loss would be incurred, and I've got 15 months for this ETF to go up. Actually, if it stays flat, it still makes a profit even if it stays flat, just where it is now. If the ETF goes up 20% between now and option expiration, this will make a 50% return. If it stays flat, then you get a 26% return, and if it goes down 20%, you just about break even on the trade. So that's a pretty low risk trade. So again, a 20% increase in the ETF price would result in a 50% return, and a flat ETF price would be a 26% return, and you have more than 20% of downside protection. Now I'm going to show you an example of a bearish option spread that I took, and this is on the Russia ETF. I bought the November 08, which is next month. I bought the 50 strike put options on August 26th at 14.50. Now these put options, of course, they profit if the Russia ETF goes down in price. And the Russia ETF was on a GPS major trend sell signal. Here's the buy of the Russia ETF 40 strike put. Yeah, it was a total of 10 that I purchased right here. I then sold 10 of the November 45 strike puts on September 9th. So that was less than 2 weeks later. I sold the 45 strike put for 13.6 points. Now when you do a bearish option spread, you want to buy a put and sell a put with a lower strike price. So the analysis I'm going to show you here shows the risk-reward profile for buying the 50 strike put at 14.50 and selling the 45 strike put at 13.60. The cost of this spread was only $90, 0.9 points or $90. That's because I bought the put for 14.50 and sold one for 13.60. So the difference between the buy and the sell, 0.9 points. Once you do that, of course, it makes it a very low risk trade. If the Russia ETF goes down 30%, you still make the full profit potential. If the ETF is flat, you still make the full profit potential, which is 455% in this case. And if the Russia ETF goes up 30%, to 44.46, you still make the maximum profit potential. And the Russia ETF right now is selling at about 15. The spread trades allow you to reduce your risk from your initial put option purchase by selling a put option with a lower strike price. And again, the maximum risk for this spread trade was the cost of the spread, which was $90 in this example. Now there's a way to enhance our returns using the two beta funds, whether they're bullish or bearish. There's a lot of these two beta funds available. So if you get a buy signal in an ETF, you can buy the the 2 beta ETF, and if you get a sell signal, you can buy the 2 beta short ETF. So, of course, that is going to increase your returns. It also increases your risk. So here's an example of some of the 2 beta funds that are available. They use leverage to increase your returns. But buying these funds, it's still a limited risk trade. You can only lose what you invest. So even though the fund uses leverage, there's still a limited risk trade. So here's an example of using the GPS system for buy and sell signals for the emerging market ETF. But instead of buying the ETF, you buy the double beta ETF. And when you get a sell signal, you buy the double beta short ETF. And here's the return over a 5-year period. The returns, it produced a $72,000 profit. Total return over 5 years was 700%. And the average annual return was about 145%. The double beta funds obviously increase your return, but that comes with more risk. And here's a profit graph of the using the double beta emerging market ETFs. From 2003 to 2008. Here's an example of using the double beta for the S&P 500 index. Over the last 5 years, it produced a $15,000 profit, total return of 160%, annual return of 32%. And here's an example of the growth of a $10,000 investment using the enhanced funds or double beta funds versus the 1 beta ETFs. Now, with the GPS system, if you get a buy signal, you can also purchase a call option. If you get a sell signal, you can purchase a put option. And what I did here was I'm going to show you some examples of call options I purchased and then compare that, the holding period of the call option, compare that return to buying the ETF itself. So I'm comparing the return of the option versus the return of the ETF. In 2006, I bought this is the emerging market call, the June call option right here at 14.20. And then I sold the call about 6 months later on June 14th. And purchased the call at 14.20. 6 months later, I sold it at 29.30. And that was a $7,500 profit after commissions. That works out to be about 106% return. Now what I want to do is compare that to buying the ETF itself over the same time period, just to show you the leverage that options provide. Here's the closeout of the 5 options 6 months later. Over the same time period, when I purchased the call option on December 12th of 2006, the ETF was trading at 111.30. And then 6 months later, when I closed out the call option, the ETF was trading at 129.20. So that's about a 16% return for the ETF. And over the same period, the option had 106% return. So that's about a 6-to-1 leverage. Actually, it's 6.6-to-1 leverage. So the options, in this case, provided leverage that was better than 6-to-1. A question? The question is, if it's a long-term system, why would I only buy the 6-month options? When it comes to buying calls or puts, I usually go 6 months out. You don't know when if the system is going to turn short over that period, so you just have to pick a time frame. And I usually go either 3 months or 6 months out if it's just a straight call purchase or a put purchase. Because you don't know when, you don't want to buy a LEAPS option because you don't know when the system is going to go bearish. Okay, so with the 6-to-1 leverage, again, if you just purchased the ETF, you'd have about a 16% profit. It would have been a big investment, $11,000 to buy 100 shares, and you have a modest profit. But with the call option, your investment is much lower and your return is much higher.